So, right, let's say you have early days of GameStop. We'll just use GS, right? And again, these are not the right numbers. I'm just giving you an example, right? Let's say the company was worth $100 million. Okay, let's see, I think you put extra, three, how's that? Three, and 3, good, right? $100 million, okay? They wanted to raise $30 million. So what would happen is that if $30 million was raised, it was $100 million, that means afterwards it would now be 130 million shares outstanding. Because you would issue 30 million more, $30 million worth more, right? And that money would go into the bank account of GameStop. So now you would have out there, you would have $130 million worth of stock. The question of what price is it at, well, that depends. So what you have now is here's how you calculate a stock price. And this is really the most important thing of all. We get down to what's called market capitalization. So let's say you have a $100 million valuation for GameStop. So here's what you could do. You could say, fair enough, it's worth $100 million. Let's price the stock at $10. And now the insiders are going to have 10 million shares. So now you have 10 million shares outstanding. Each one is worth $10 million. That means the whole company before it went public is worth $100 million. That's how you get a stock price and where the shares come from. Then you can say now the company itself, these 10 million shares are owned by those principals, those 3 founders. They don't issue stock. What happens now is GameStop, the company, will issue 3 million shares. They will issue 3 million shares at 10. So now when they issue those 3 million shares, $30 million minus fees goes into the company's bank account, and the number of outstanding shares rises to 13 million. So the post valuation is 130 million. You have 13 million shares outstanding, priced at $10 a share. If the stock starts to trade hard, let's say it goes to 20 now, the company's worth 260 million. That's what's called the market capitalization of the company. The market cap. This is the single most important thing when you're looking at a company when it comes to fundamental value. How many shares are outstanding and what is the price of each share? A stock could be $5 a share and the company could be incredibly valuable if there's 5 billion shares outstanding. That would be $25 billion valuation. Similarly, a stock could be trading at $1,000 a share and could be not valuable, it could have only 100 shares outstanding. It's a $100,000 company. So it's always the combination of whatever the share price is times the number of outstanding shares. Based on that, you get what's called the market capitalization, and from there, all things start to be analyzed.